return, for example, 5%. Returns like this are calculated using formulas. I'm going to give you some examples of formulas here. But don't worry, you don't need to memorize these yet. I just want to point out that return formulas have one thing in common, and that is that they are based on two inputs, market values and flows. These are the two inputs that drive the return formulas. And how do we get these inputs, market values and flows? They are based on the processing of input data, and that is what I'm going to refer to as operations and portfolio accounting. In this video, I'm going to walk through this four-step diagram using an illustrative example so you understand this process at a high level. I'm first going to start with market values and flows, show you what those are, then apply a formula and show you how to calculate a return. And then after that, I'm going to go back and show you what I mean by operations and portfolio accounting. Remember earlier I said that by the end of this video, you should feel confident about why you are learning about operations and portfolio accounting in a performance course. You can see here how this is the first step in the process of calculating a return, and therefore knowing about this topic will give you a good foundation for your performance learning journey. I wish I knew about this topic earlier, and I want to give that to you here so you don't have to struggle like I did. Okay, so first let's show you what I mean by market values and flows, which is step number one in this diagram. Let's say an investment manager has a client, Remy Enterprises, and this investment manager is managing Remy Enterprises' investment portfolio, which contains stocks and cash. Let's say at the beginning the portfolio is worth $100, and at the end of the period it's worth $107. The starting value of $100 would be called the beginning market value, and the ending value of $107 would be called the ending market value. Okay, so this is one of the inputs I mentioned, market values. Now what about the second input I mentioned, which was flows? Well, flows are when a client, like Remy Enterprises, adds money or takes money out of the account. For example, Remy Enterprises could get extra money they want to invest, so they add money to their portfolio. Or they may need their money back and withdraw it from the portfolio. These are called flows. For this example, I'm going to assume Remy Enterprises wants to invest more. So it adds $2 at the end of the period. So now we have both inputs, the market values of $100 and $107, and the flows of $2. So now let's take a fresh look at our flow chart. Now that we have these values, what is the next step in the process? That's right, plug these into a formula. Most firms will have a formula they use. So we are going to assume this investment manager uses the formula here. Return equals ending market value minus beginning market value minus flows over beginning market value. Let me show you what this is doing in plain English. Let's start with the numerator here. This is using market values and flows to find out how much money Remy Enterprises made or lost. In other words, their gain or loss. The first part here is taking the difference between the ending market value and beginning market value. Remember, we started with $100 and ended with $107, which is a change of what? That's right, $7. So does that mean we made $7 on $100 for a return of 7%? No, let me show you why. And it has to do with this part here where we remove the flow. Okay, so remember that $2 came in from the client? That was money from the client's pocket. Well, that means that $2 of the $7 change in market value was not from investments. It was a change in market value due to the client putting money in. So if $2 was due to the client putting money in, how much of the market value change was due to investments? That's right, $5. So when we remove the $2 flow from the $7 change in market value, we get a gain of $5. That means that REMI Investments made $5 on $100. So what was REMI Investments' return? That's right, it was a 5% return, not a 7% return. Let me give you a completely different example to hammer home this point of client flows versus investment gains and losses, because it's an important one and it will come up again when we get to operations and portfolio accounting. Okay, so here is a different example to hammer home this point. Let's say you have a regular bank account. Here is your statement. You started the month with 100 euros in the account. During the month, you deposited 50 more euros. There you go. And then on your statement, it says you earned 2 cents in interest. Therefore, your ending balance is 150.02. Look at this. You had an increase in market value in 50.02 euros. Does that mean that the bank earned you more than 50%? No, the bank gave you 2 cents on your money. You were the one who added 50 euros from your pocket. So should the bank get credit for giving you the 50 euro increase? No. So deposits and withdrawals in a bank account are similar to flows in an investment portfolio. Deposits come from the client's pocket and withdrawals go into the client's pocket. And these flows, deposits and withdrawals, are not treated as a gain or loss in the return calculation. The bank, like the investment manager in the other example, only gets credit for changes in market values that are not due to flows. So let's go back to our other example. Remember where we said there was a $7 increase in market value, but $2 was a client flow. So only $5 of that was an investment gain, which the investment manager will get credit for, and hence the 5% return. Okay, so now back to the flow chart. We got steps 1, 2, and 3. And the important takeaways so far are that the inputs into return formulas are market values and flows, and that changes in these market values could be due to flows or investment gains or losses. And the return formulas will treat these differently. So now the only piece we are missing here is that first step, operations and portfolio accounting. What do I mean by this and why should you care about it? Let me first show you what I mean using 2 examples. The first example will be a trade and the second example will be what's called a corporate action. And great job following along. We are more than halfway done with the video. So the first example I will show you is a trade. Here is a portfolio manager who decides to buy a stock, XYZ. Let's say they buy 1 share of XYZ for $124.50. With transaction costs of 50 cents. This trade information is within the trading system. Then that trade information gets sent from the trading system to the portfolio accounting system. The accounting system will reflect this trade as a transaction, like this one, that will have the trade information plus the net amount of the transaction, which is the total cost of the purchase. So in this case, that is $125, which is calculated as the cost of 1 share at $124.50 plus 50 cents in transaction costs. Okay, so now that you understand the flow of the trade coming down from the trading system into the accounting system, I'm going to move this off the screen and just focus in on the accounting system. Okay, so now that the accounting system has this transaction, now what it does is it will apply a program to figure out what impact this has on the market value of the account. So for example, when you buy a stock for $125, that means you will owe someone $125 in cash. The liability of $125 is called a payable because it's cash you need to pay. And in this case, the payable would be negative $125. And that will be negative because it will be money coming out of the account. Now you also own the stock, and that would be a positive value and would be dependent on the price of the stock. So let's say stock XYZ is worth $126 at the end of the day. And because we own 1 share, That means the market value of securities would be positive 126. So the total impact of this trade can be derived by summing these at the end of the day, which results in plus $1 or a gain of $1. Okay, so this was the first example to illustrate what I mean by when I say operations and portfolio accounting. And you could see how this trade flows into the market values, which is then used for returns. Now, before I go on, I just want to make a quick disclaimer about these examples. First, these are simplified examples I'm showing you that do not reflect all the systems and parties involved. So don't go running off and claiming that this is the official system flow of a trade. This is just meant to give you a high-level idea of how things work. And second, the portfolio accounting principles I'm showing you here are not official accounting entries. I am not an accountant, and this is not an accounting course. The main point here is to show you how transactions and holdings impact market values and flows for performance purposes. Okay, so now that we got the disclaimers out of the way, I will show you the second example, which is called a corporate action. Now, there are many types of corporate actions, but the one I will show you here is called an acquisition, or one company acquiring another. For example, let's say company big announces in the news that it's going to buy company small, and your portfolio owns stock small. That means your shares of small are no longer going to exist because that company is being bought and they are going to be replaced with shares of big. This change in shares might look like it happens automatically, but there's actually a process behind it. So the company first announces the event, then data vendors collect data on these events, and that is sent to investment managers. At the investment manager, there's usually a corporate actions team, maybe within operations, that enters or oversees the data of these events in the accounting system. And in this example, let's say the terms of the acquisition state that for every 5 shares of small, you get 1 share of big. And the date of this event that the acquisition will occur is March 3rd. Now it's March 2nd and you own 5 shares of small. Small was worth $20 a share at the end of March 2nd. So the market value of the position is what? That's right, $100. And that means that the market value of securities is $100 on March 2nd. And if that's the only thing that you held in your portfolio, that means your portfolio market value would be $100. So on the date of the event, March 3rd, the 5 shares of stock small will be replaced with 1 share of stock big due to the acquisition. And let's say big is worth $102 at the end of March 3rd. So the market value of the position is $102. And the market value of securities on March 3rd is $102. And if that's the only thing you hold in your portfolio market value would be $102. So your market value went from $100 to $102. And these market values will be used in performance as we have shown earlier. Okay, so these were the 2 examples to show you what I mean by operations and portfolio accounting and their impact on market values. And now lastly, I will show you why you should care about these transaction types and processes when you work in performance. Let's say you work in performance. Here you are crunching return numbers. Well, it's common to have someone come up and tap you on the shoulder and ask you what caused that $5 gain that led to the 5% return. Did it change due to a valuation of a certain stock? Was it due to a trade? Was it due to a corporate action or a class action? As a performance analyst or working in this field, you will need to understand what these people mean when they say all these terms. Or you might have another person ask you if something should be processed as a flow or not. You will need to understand how things should be processed to correctly advise people on what to do. This is what I mean by operations and portfolio accounting. And since this is the starting point for deriving market values and flows, which drive returns, you will want to understand this foundation before you move on.